My name is Nicodemus Dahlgren, and I'm responsible for the sales team here at East Capital Group. And we're thrilled to have so many of you with us here today, both here in the room, but also joining us online. Today we have participants connected virtually from countries across Europe, China, India, UK, and the Middle East. And it's a pleasure to host you on behalf of East Capital Group. Since our last summit in November, held just after the US elections, the world has only grown more complex. We have seen escalations in trade tensions, fresh geopolitical uncertainty, and continued economic divergence across markets. And yet, through this volatility, we have also seen increased interest from clients seeking emerging market diversification, resilience and exposure to new investment opportunities. Within sales here at East Capital, we have seen an increased activity in searches for emerging market across clients in Europe and the US. And we're very glad and proud to have won several mandates for our global EM strategy. A strategy where our IM team has had a 100% hit ratio of outperforming the index over 3 and 5 years rolling performance since inception. And I think this highlights the strength of our investment process in these dynamic markets that we have. We're also very proud that Lipper recognized our performance in our mixed asset strategies 2 weeks ago. First, it was for East Capital Group for best mixed assets small company, and then also for Ispiria 60 for best mixed assets balanced over 3 years. And if we look at the Ispiria family, the AUM has actually grown with over 50% since the beginning of last year. And this is driven by very strong return and performance from our investment management team, but also increased interest from clients across the Nordic region and European institutional investors. And I think that's also a testament on how we can navigate these dynamic markets that we live in. We continue to also gain market share in the Nordic fixed income space, where our Ispiria Nordic Corporate Bond Fund that we launched just 2.5 years ago actually attracted 11% of the total flows into the asset class last year. And the strategy has grown with more than 20% since we last met in November. So there's a lot of things happening within the group, but we're also excited that we have a lot of new interesting upcoming investment opportunities. We plan to launch a small cap strategy on the equity side, Ispiria Sweden Small Cap. And we have also a lot of interesting investment opportunity within the real estate space, both fund investments, but also interesting co-invest opportunities. So I think today's lineup just reflects just that, a global conversation with perspectives from investors, asset owners, and asset managers. So with that short intro, I would like to directly hand over to our CEO within East Capital Group, Per Elkjær.
Thanks very much, Nico, and from me as well, a very warm welcome. Today we have 4 extremely interesting and valuable, call it panel debates or conversations regarding topics that are extremely timely. The first one is called Macropulse, where we will look at trade wars and rising protectionism. The second one will be the magnificent Nordics. We are still in Stockholm, and look at the strength of the Nordics in a very competitive and complex world. The third one is to call Rising and Resilience, where we look at the emerging and frontier markets. And we will sum up by looking at the East European market on a fireside chat to see what opportunities are in that part of the world. But before, of course, these are swinging times. I've been in this finance business for almost 40 years now, and the last few weeks have been remarkable. So things that we might have said on Friday may not be as applicable today. But so we feel very lucky, actually. It wasn't staged like this, but it's very timely conversations. And before we go to the first channel, I would like you to look at the chart as far as from the beginning of the year, the swing in the global markets, emerging markets, frontier markets, and developed markets, basically. And one can say that it may be highly relevant today, it may be irrelevant in a week from now, who knows? But you can say the divergence and the level of anticipation and how people react to tariffs and other things in various parts of the world. So with that context and with the volatility, I would like basically to welcome our first panel, Kristin Magnusson Bernard, the CEO of, in Swedish, AP1, in English, First National Public Pension Fund. Anders Borg, who is a senior advisor to East Capital Group and also a former Minister of Finance. And David Nichols, there you are, who is a senior, I will move here actually, who's a former senior fund manager with East Capital. And we have a lot of things to talk about, and we have a limited number of minutes. So I'll dive into it. And my first question is to you, Anders, basically. Even though things have changed over the last 72 hours, how's the shift in the surge of US tariffs, basically, how's it changed the global trade and the landscape? And what sectors are more or less at risk?
So we were in a situation fairly unexpected that Trump would unleash this trade war with fairly large impact on particularly industrial sector and investments. Not a major crisis event, but a mild recession with US economy taking the hardest hit, a bit of headwinds for Europe and fairly marginal impact on China. Now, after the last proposal, we are in a new world. So we were at 23% tariffs. We were hoping for 15, and after the last announcement, we're a little bit above 10%, particularly if you assume that you will have an EU deal close to UK. That basically is a percentage point lower US growth, maybe 2% drop in capex, and maybe half of that effect in Europe and a third of that in China. So now we're not talking of a major event anymore. So the stock markets actually, I thought the stock markets was wrong. The stock market was actually right. He backed down dramatically. Obviously, we have no clear pattern that we could trust on what he will do in the future. So it's still a very volatile world, but it's a much better world this week than it was last week. And that's kind of a reassuring, I must say.
So Anders, if I just one question before we hand over to Kristin. Do you see, even though things have changed quickly, are we going into a sort of like a prolonged area of protectionism, or is this more of a cyclical thing?
Well, I do think that this is a bit of a stagflation situation. We will have inflation slightly below 4% in the US. You will have US growth at roughly 1%. So we're not going back to the Goldilocks that we had the 31st of March with high US productivity and strong consumption and everything. So it is not as good as it was. But I do think that given Chinese price competitiveness, they've cut export prices 15% over 2 years. These tariffs will not hinder the trade. I mean, it will be a bit of a worry, but it will not be a major shock to the container market. We will still have China exporting, obviously more to India, Southeast Asia, Eurasia, and so forth, but they are not losing their whole market share in the US. So the part of the capex hit that came from global trade turbulence have been turned down quite substantially.
And if I move over to Kristin, as a very large asset owner, how do you basically balance the long-term commitment, long-term responsibility with the short-term fluctuations in the marketplace?
That's a great question. Thanks so much for having me, and thanks for inviting me today. I'd say that it's sort of a number of issues we try to keep a firm grip on. The first one is really liquidity, front, right, and center. Whenever volatility rises, you need to be sure that you plan not only for a worse liquidity situation, but a much, much worse one. So you really try to stress test your portfolio for all the things that might happen. If you, like us, have a large derivatives book, you know that it can move anyway in different parts of the world, in different parts of time zones, like many of our guests in the audience, and to try to just be a little bit one step ahead, I'd say is key. But the other thing, coming back to the other part of your question, is the long-term horizon. We also really try to talk to our investee companies to try to keep that long-term horizon. I see a real risk that actually this is sort of a dampening, a wet blanket on all sort of forward-looking investment activities. Coming back to Anders' points about investment might be the engine through which this suffers. I think there's a real risk that we kind of lean back into a wait-and-see mode. It's also unpredictable. So that in and of itself could hurt growth and hurt profitability. So very much trying to balance the long term and the near term.
Thank you. Well, that moves us to David, basically, as far as corporates and companies are concerned. How do you see the emerging market changing or adjusting their strategies in the light of what the tariffs and what we just discussed?
Yeah, sure. So I guess starting on a sort of macro basis, right? And really all the countries we speak to. I was in New Delhi for a really great day a few weeks ago, and their main focus is obviously to reduce the trade friction, i.e. reduce the tariffs, right? And you saw that obviously with China. Over the weekend, we've seen it with UK, and actually we expect over the next month, there'll be a range of trade deals announced broadly along the same sort of level. So that is utmost incentive, and governments believe they can negotiate with the US, and I think we've seen that is the case. But I think apart from that, it's really, as Anders was hinting at, this idea of diversification away from US as sort of a primary equity export market. But that's already been happening for a long time. You know, if you think about China, for example, currently only around 15% of Chinese exports go to US directly, around just over 2% of GDP, which I think is a lot lower than many sort of investors really think when we speak to them. And sure, that it may be a bit higher if you include the re-exports, but the general message is really the case that Chinese exports are growing very rapidly to the rest of the world. And I could provide you with lots of numbers, but I think that the best way to illustrate it is just to talk about a conversation I had with a Brazilian analyst actually 3 weeks ago. He said, you know, when I was growing up, Chinese goods considered very tacky and cheap and plastic. Now, you know, he's a 30-year-old aspirational banker. He wants to drive a BYD car. He wants to have a Xiaomi telephone because they are just the best. You know, they offer the best technology. Think about how Apple's AI integration is. It's non-existent, right? But if you look at a Xiaomi, it's much better. So I think, yeah, that's the real focus for them. And in China, the second part, which is probably almost more important for equity markets, is the real drive to increase domestic consumption. Obviously, if you're going to export less, you need the consumer at home to buy more. We've seen 62 billion of subsidies for sort of buy-in programs for white goods, huge amount of support for real estate, stock market, things like that. And we think that sort of drip feeding of policy is going to continue going forward, which will obviously be good for the Chinese equity story.
Thank you. Very timely once again, going back to Christine. So being large institutional investors, a lot of media coverage, how do you navigate, basically? I mean, you all talked about derivatives and short-term liquidity versus the long-term, but still, in real life, how do you navigate these things? Political pressure and tariffs coming on, more or less accentuated, basically.
Well, that's a big question. How much time do we have? No, I'm just kidding. But to me, it really starts with how do we process the information flow? And that's one part. And the other part is how do we stay true to our mission, to our core values, etc. But if I start with the information flow, because I think Anders did a beautiful run through of how things have changed. And if you invest someone else's money or your own money for that matter, you need to remember, what did I think yesterday? What was my assumptions yesterday? What has changed? How will I act upon that information and why? Because it's very easy that you just flip-flop around with the latest headlines, and it's hard to invest consciously, but it's also even harder to explain why you did whatever you did. So we have worked a lot sort of through decision trees, and we try to timestamp them. So this is what we thought yesterday, this is what we're thinking today, this is what has changed, so we can kind of guide anyone through our own thinking, including ourselves or our board or the society at large. And it kind of helps to process and at least to have some sort of structure in this sort of chaos, if I may call it that. And it also helps to kind of find what are the underlying assumptions. You know, you mentioned diversification. We all build our portfolios on assumptions, you know, that the dollar should behave in a certain way and stocks and bonds should behave in a certain way. And sometimes they don't, like this spring. And then at least you need to be very conscious of why you did thing and what you thought going into that. So try to make your own thinking transparent to yourself first, and then at least you have a better chance to explain it to the outside world, I would say.
And feel strong enough to stick with it, basically.
Yes, exactly.
Yeah. You mentioned chaos. I mean, it's been chaotic, but that also creates, and that can be seen as threats, and we've seen that in the marketplace, but it also creates huge opportunities, of course. So David, the trend with nationalism, protectionism, and nearshoring, give us a feel for the opportunity that actually.
Yeah, no, it's a good question, but I think really echoing what everyone else said, we're not panicking, you know, and we're not seeing this as a completely radical shift in global trade patterns and a completely new changing world, right? I think it's especially after this weekend, but even before then, I'd say our view wasn't that things are going to change. And I think if there's one number you remember, so 98% of umbrellas imported into US came from China last year. You know, what's going to happen if there's 140% tariff on those umbrellas? The umbrella companies won't absorb that, and it's not going to stop raining, right? So of course that would be highly inflationary. For the person that would suffer will be the US consumer. So as a result, I think it's not a huge surprise that you've seen this rapid de-escalation. And of course, there's even further to go if you think about this 20% fentanyl sort of additional tariff that we're seeing on China. So no, I think the highlight is that we're really not panicking and not seeing this radical shift that maybe, I guess, the markets really feared around this sort of Liberation Day where there's this huge fall. In terms of opportunities, there are obviously countries that will benefit. I think Mexico is one that comes up. India as well. You know, Apple want to create most of their or all of their iPhones they sell to US. They want to manufacture them in India within a few years. But of course, as my India analyst Ratish always highlights, and when you're in India, it's very clear. It's very obvious this is really only assembly for the time being, which doesn't add that much margin. So it doesn't create that many investment opportunities. Actually, what's more important is the broadening out of the supply chain. And we think and we hope that will happen, but it really will take a long time. And in fact, I think if you look at really opportunities, probably the most one is, again, we've alluded to, with all this chaos and this policy uncertainty, which is a nice way of calling it, in US, I think it really, investors are now starting to think, you know, do I really want 70% of equities or 80% in US, given these sort of the high valuations and the chaos and things, and starting to look abroad, to places like emerging or frontier markets and things like that. So I'd say sort of as an asset class, that's really where, you know, we see interest, and maybe later I'll speak to a few more specific country examples. But yeah, I think that's probably the exciting part.
Great, and we are stock pickers and bond pickers at the end of it. Yeah, back to you, Anders. Once again, how do you see Europe, the rest of the world that haven't? There's a number of countries or regions still haven't sort of settled with the US. What do you see going forward?
I think it's important to stress that we've had a series of good news from China. If we go back 6 to 9 months ago, it was Kevin Rudd's story that Xi Jinping was going to turn China into a real socialist state. We had tech clampdown, education clampdown, private sector clampdown. Now they reversed. So clearly the tech are now liberated. DeepSeek has provided a lot of support in terms of prestige. They've started to do the right thing on cutting interest rates. So yeah, China looks actually, we were worried that they were going to be lag out or being kind of locked out from global technology, and DeepSeek really showed that they could adapt much faster than anybody thought. So that I think is really good. Well, if you look at the UK deal as a template, you would probably have fairly large European sectors. Think about machinery, chemicals, pharma, to mention the big ones, on the 10% level. You're quite likely to have automotives at the level of 25, but with a quota up to some number, where you probably see a 10% tariff. So you remember that BMW CEO at the quarter said that they were going to be good in July. I thought he was kind of hallucinating a bit, but he might be right, because if you look at BMW with most of their production for the US market in the US, and if you then assume a quota and 25, I think a company like BMW will be in much better shape than, for example, Volkswagen. So yeah, the big hit on automotive remains. It's the EV in combination with the lack of energy and also some tariffs. So Europe is going to get the trade deal, but I do think that we, in effective term, probably are now talking slightly above 10%. You're not the 6.5% that you got for the UK, but definitely not the 16, 17 that was in the old trajectory. So even Europe, I think, is in a better shape. And if we then get some peace deal in Ukraine, we're all hoping and praying, then I think that in combination with a bit of German's fiscal stimulus could provide not a great time, but maybe 1% strong boom in Europe, not 2%, but 1%. That's kind of good, happy days in Europe.
And the $64,000 question, then, of course, is how much pressure is now Trump and the EU basically under, given the quick resolution with China, i.e., when do we see this? That's a trick question, but still. You've been there a few times in the old life.
Yeah, I mean, predicting the unpredictable in terms of Trump, I mean, that's the known unknown. I don't think we should kind of try to guess that, but you have the NATO summit. He's likely to take home fairly large deliverables. Some countries going to 5%, all going to 3%. Germany and Sweden probably above 3%, so he can claim a lot of export gains for US defense industry. We might see an LNG deal with Germany now that the Greens are out of the government. So you have those type of components that could be helpful. So let's say that we could get it, maybe not during the 90-day period, because it's probably the most difficult deal to negotiate. And obviously the European negotiators kind of feel that, yeah, we can push this guy, and they will try. So, but let's say that they can do it during summer at least.
Good. Christine, you already mentioned this, but if you have a lot of money, a long-term horizon, come back to what David said, how do you see how do you adjust? It might be premature, but how do you think about adjustments of allocations regionally, structurally, going forward for a long-term, basically pension fund?
Those are great questions. I'd like to come back to the theme of diversification and also about challenging your own assumptions. I think some of the most interesting things that happened at the fund this spring was how people actually started questioning their own beliefs, both around the US, Europe, but also around emerging markets. Because sometimes people, even portfolio managers, they get a little stuck in their ways. And sometimes you have a view of things that might not necessarily be current. And there's always a risk that you stop questioning yourself. And when I heard, I have a very senior portfolio manager, he's a permanent US bull, been for decades. And he said, well, I'm actually changing my mind. Then we had the rates guy who all of a sudden was bullish on the stock market. We had the equity guy who wanted to take down our risk allocation. And we had people who said, like, look, emerging markets are looking much sounder than some of the developed parts of the world. And they started looking into what kind of inflows do you need to the US to sustain the valuations you currently have. And once you start doing that math and you see that the US needs to attract maybe 75% of global savings on a sustained basis to keep valuations high, well, then people start looking around. And I think that's a very healthy way of doing it. And you should let that process run its course, take its time, not do anything too quickly. But definitely I see, and also when I speak to my peers around the world, there are major shifts underway. Yeah. And it comes back to the sort of basic can we trust US debt the way we did? And then you're really talking about the core parts of the market. So it's a very exciting time to invest. And there's some big questions out there. But as you say, I think there are locations and companies who are very well placed to actually attract that sort of capital. But I think people are, as you say, there's no rush. People are actually quite wisely thinking about, for example, Europe, what's the next leg of the story? You have the defense spending, you have the infrastructure spending, for example, but then you need productivity and you need entrepreneurship to get to the next stage. But we had a visit from Silicon Valley, which was really eye-opening, because it was like, look, Kristin, all you Europeans, you say we have no capital markets and this and that is not functioning. There was nothing in Silicon Valley in the 50s and 60s. There was actually CIA who put money into Stanford to have this incubator of firms, and that was the source of Silicon Valley. So, you'll fix it as you go along. And it was kind of an eye-opening view also of how capital markets actually are developed.
I think that was a fantastic answer and a very timely answer as well. I.e., who knows, right? Who knows? You need to adjust. You need to have a clear idea what you're doing, what basically your mission, your responsibility is, to make sure you can adjust and take the right decisions and not be basically scared into too short decisions. So with that, I would like to thank Kristin, Anders and David for the first panel. What you see on the screen now, thank God for AI, right? We are moving from the global scene to the slightly more narrow Nordic scene. And the picture, for those who don't live here or never been here, is a combination of a salmon, very much, not only, but very much related to Norway. We have a big truck. I don't know if it's a Scania or Volvo, but still that's Swedish. We have woods, forest, paper pulp companies. And as you can see, I'm not going to read everything, but the Nordics are characterized by what I just mentioned, a pretty diverse set of industries, a stable political, usually, infrastructure, and that also provides very stable returns, both from an equity point of view and a fixed income point of view. And that, as an introduction, I would like to invite Peter von Berlekom, who is very senior portfolio manager for Expedia, Erik Karlsson, who is a fixed income manager, and Staffan Östlin, also an old veteran from the equity market. And the topic is the magnificent Nordics, not the Mag 7, but the Mag Nord, and how resilient are we in the Nordic markets? And starting up with Peter, with the Nordics basically being perceived, right or wrongly, as resilient in a relative terms, what structural support or how does it affect the Nordic markets, what we're now seeing in the world?
Yeah, just starting off, yes, it should be resilient, but of course with the trade war, it just upheaved all what we stand for in the region with competitiveness and export markets. But we are in the longer term resilient as companies are very efficient. They manage their operating costs, and we have also a very good tax regime. So Nordic companies are on average more profitable than others, and they can invest and they can prosper and grow, and they have done so for decades and investing abroad, etc.
Erik, we've had, as Nico Zeman said before, we had a fantastic success with our bond fund, corporate bond fund over the last 2.5 years. Given what we discussed, the fragmentation and concerns in the global market, how does the Nordic trade markets basically, how do they feel?
So I think we've had a month of turmoil now, and I think the Nordic credit markets have performed well. As I said, April was turbulent. We saw global credit spreads or risk premiums widening quite fast in the first days of April. Nordic investment grade market performed roughly in line with what we saw in the US, in Europe. Nordic high yield, on the other hand, which to begin with has a higher credit spread or higher risk premiums, actually widened a bit less compared to US or European peers. And I think there are a few explanations for that. First of all, the repricing is perhaps a bit slower in the Nordics, smaller market, but also what characterizes the high yield market in the Nordics is smaller companies, typically unrated, more regionally focused, which means that tariff concerns, for instance, has been less dramatic. So, and on top of that, you have, I mean, if you look at the Nordics, we have low political risk, we have the macro situation, and the financial stability of the countries is supportive as well. So overall, I would say it's good.
I'm not going to let you go, either one yet. So next question, basically, as we spoke about with David, chaos, concerns, volatility creates huge problems, challenges for the markets, but we've also seen it also creates fantastic opportunities to invest. Equity markets, fixed income markets, you got 2 minutes each to basically, where do you find the most appetizing opportunities right now?
Yeah, I stick to my old ideas, really finding those profitable companies and those with high margins, what we call quality. And as you say, a backdrop in the general market, you can find fantastic business models in various sectors who will have a positive earnings trends. What I also look at is sort of a normalized earnings. So we try to find companies, not really what are undervalued, but we see the long-term potential and evaluate companies and not the stock price.
But we don't mind if they're undervalued either, do we?
No, that's into the equation, but to evaluate them is really on fundamental metrics.
Yeah, so our mindset, or as a credit investors, are a bit different compared to Peter and Staffan. We are more focused on the downside. The upside potential in bond investments is, of course, a bit limited. From our point of view, I think it's more about allocating risks prudently to limit risk of defaults rather than finding the undervalued company with solid growth potential. That's a positive as well, but we don't get that upside as much. So for us, diversification is key, and I think the Nordic markets provide that. We have a wide range of companies in various sectors which provide for that diversification, and we can also, from that standpoint, we can decide to selectively, of course, go further out on the risk scale to find companies to enhance our performance with higher risk bonds, of course. I think if you look at, I mean, April was turbulent, but we have seen that credit spreads have gradually decreased since then and still are decreasing. Still, high yield spreads in the Nordics are wider compared to the beginning of the year, which means things are more cheap, which provides opportunities, of course. And I think, given with the Nordic backdrop, with that things are a bit cheaper, and the fact that as a bond investor, you're always going to get your money back unless the company defaults. And I think that is actually something that is attractive with the credit markets, with the Nordics, especially in periods where you have a bit more turmoil.
So there's still much to do.
Much to do.
Good. Staffan, going to another segment that has categorized very much of the Nordic markets over the last 5-6 years, a huge increase in number of small entrepreneurial companies that you've been focusing on for a long time. How do you see that area of the segment of the market being affected and risks and opportunities created in the small cap scene?
Yeah, and just starting off by saying that small caps over the last 20 years has outperformed large caps in Sweden by 6 times. So it's a really, really interesting sector or group. I think finding the most attractive bottom-up ideas. I think what has worked over the last 15 years is really serial acquirers. Not sure if that is a group. I tend to not say that it's a sector, but anyway, and if you look at the large small cap funds today, they basically own these companies. And I think here it's an attractive business model to be a serial acquirer, but you want to do it by purpose. You want to get out synergies. And I think that you can find small gems here if you look at the smaller ones. But I think one very interesting area is the medtech area. Looking at Sweden and the Nordics, by the way, we've had a history of having very successful pharmaceutical companies. And around these, you've also created clusters of medtech companies. And medtech companies, those are interesting because they are quite often very scalable business ideas. Looking at the history, we have a number of success stories, and there's a lot of smaller caps out there. And I do see that a lot of the institutional investors avoid the sector because they don't have the trust or knowledge about it. So that's, I think, is one very interesting sector.
You said they've been outperforming the larger cap companies significantly over a long time. You may not have from the top of your head, but if you go back 1 year from now, basically, how just for information, how's that performance been? Small cap versus large caps?
Small cap versus large caps over the last two years has not been outperforming.
Okay, so they lost out to the large caps.
Yeah, and if you look at historical correlations, I mean, driving share prices over 10 years period, that is really growth, which is the most important thing. Over the short-term period, it's more multiple expansion or changes in multiples.
So if we stay with Peter and Staffan and then talk about your favorite game, stock picking. How important and what would you favor in an environment where opportunities are being created, there's concern, there's nervousness, there's higher risk premiums? What sectors and you can talk about companies as well. Would you prioritize in an environment where we are right now?
Really starting with looking at unique businesses and where we typically are the best leadership position and strong leaders. So mining equipment is a sort of a very strong area in Sweden. We have selectively consumer names within sort of outdoor space. We have a lot of industrials who are interesting, from the biggest to smaller companies. So Staffan mentioned pharma companies, but those successful in the last few years are also fairly big companies. But looking at leadership position, I think that is really the key.
And large Swedish corporations have typically pretty strong balance sheet, correct?
Yes, I mean, some are getting a little too mature, which makes that and growth is capped, but nevertheless it gives stability. But it's more how you form your portfolio with growth and more mature companies.
And Staffan, you already mentioned medtech, but if I would push you slightly more into the corner and say that, okay, widen that gap, how do you see the opportunities being created by the turmoil in the market and the change in given what's happening politically?
The change. Firstly, I would just like to stress, you can't enough emphasize how important it is to have the right management in the company, because that's really the first thing you want to look at. And also, how is the competitive landscape? Do you have pricing power? But short term, looking at over the last couple of years, the consumer spending has been rather low in the Nordic area, not only in the Nordic area. I think that Swedish market is a little bit ahead of other markets, and here we can see a lot of opportunities, because here you have a sector and stocks which has been hammered down massively, and here you want to look at what have they used this time, what have they done during the downturn? Have they just faced reality and taken down some cost, or have they faced reality and taken necessary actions? Maybe they took decisions 2 or 3 years ago with acquisitions that they now actually say that, well, we did wrong, and so they really face reality. I think one example here is BHG, we in Sweden called Bygghemma, which is a company which has lost sort of 75% of its market cap. New management came on board a couple of years ago, and they have really done their homework and taken down huge cost. And here you can say that maybe it's not a unique product, but they do have scale in their business. That's one good example, I think.
Thank you. One of the interesting things about East Capital is that, of course, we manage money globally. We own companies all the way from California to China, and we sit in basically one operation environment to share information, to share ideas. Come back to Peter. What sectors, what companies, as far as the nearshoring mentioned before, the political effects from trade wars and other things, what companies, what sectors in the Nordics would primarily benefit from having been international for a long time? Actually, that could actually benefit longer term from what's going on politically in the world.
Yeah, I think companies are generally proactive and adjust, but it will take some time. That's why we've seen sort of a weaker Swedish market. It's cyclical and it's tradable goods. But companies will adjust, and if they are bottom line very profitable, it will take some time, but they will manage. So all the classical strong companies will do well medium term. That doesn't necessarily mean that stock prices always will go up or
at least not in the short term.
No, but I think coming into it's much more difficult for smaller companies, but they're not international, and it's very much built on trust that you can evaluate them in the right way.
Following up, all three of you then, we have a few minutes left, but as an institutional, as an international investor that came down from basically land at the airport and said that how should they see themselves investing in the Nordic regions for the next 3 or 4 years? Give them the crash course.
I would build a scenario. I think for now it's a little middle of the road strategy, not to take excessive risk, very much building on trust for those who build their portfolios. And I think one other which has been neglected when you see these rising stars as Novo Nordisk, the limitations of a UCITS fund is very good, so that you keep positions at not too high weight. And we had it seen in Sweden more than 20 years ago with Ericsson. We have seen it in Finland with Nokia. And it's always be prudent and don't take too big positions. So I think the underestimated part is really portfolio construction and to take clever decisions.
Staffan, would you also stay in the middle of the road, or will you take a service road on the side of it, or where would you go?
No, but I would actually try to look at places where nobody else is looking. I think that's also how you can create a lot of outperformance.
And where would that be? Where haven't we?
Well, I mean, looking at sort of what is happening now and with the tariffs, etc. I mean, you have two companies. I don't own them, but two really big winners of this should be Electrolux and Dometic. Both of these companies have been more or less killed in the US by Chinese competition. Chinese competition will not disappear, but it will definitely be a very different landscape from a competitive
So there are
point
plenty
of
of gems out there when the dust is settled.
I think you can find
Okay,
them.
be slightly more risky then, and staying on the middle of the bond road, Eric. What would you say basically as an international investor coming to the Nordics and say, I want to buy corporates, but I want to be on the safe side, on the bond side?
Yeah, but I think the Nordics is very attractive because we have the setup with strong public finances. We have low political risk. If you look at high yield, for instance, the spreads are about 100 basis points higher compared to what you find in Europe, US. So the return potential is actually great compared to at similar risks. So I think Nordic high yield, Nordic corporate bond markets are an attractive way of allocating your capital.
Thanks, guys. Getting close to the end of this session. Once again, one of our cornerstones in East Capitals to make sure that we're very close to the companies we invest in, close to the markets where we are, to make sure that we've put both the ears and the eyes to the ground. And I think what you guys have described to us, whether it's Big Hemma or the large ones or a bond fund, I know you spend an awful lot of time meeting these companies and not investing before you actually feel confident. And I think that reflects not only the corporate side, but the overall culture within East Capital. So with that, I would like to thank Peter, Erik, and Staffan for a very interesting presentation. Thank you. And now we go into a completely different part of the world. Marcus.
Thank you, Per. Hello, everyone. Nice to be here. My name is Marcus Rågmark, and I'm also a part of the sales team here at East Capital Group. So clearly, it's been a year so far anyway, characterized by uncertainty and volatility as a result of the new Trump administration. But in this volatile environment, it's very encouraging to see both emerging markets and also frontier markets perform relatively well and significantly outperforming US markets, for instance. And we heard, Christine earlier mentioning the huge amounts of capital which basically need to go into the US to sustain the valuations. So if we now, begin to see a little bit maybe investors questioning this notion of US exceptionalism and US, buying US at all costs, we believe that emerging markets and frontier markets are quite well placed to capture some of these flows basically coming out of the US, and the numbers year to date very much support that hypothesis. So anyway, and also of course we had now over the weekend the trade deal being announced between China and the US. So I think it's great timing to have this panel, which is labeled Rising and Resilient Emerging and Frontier Markets in a Shifting World, which again, I think underlines this point that I'm making, that they're quite well placed to continue performing in the environment we're seeing. So with that, I'd like to welcome Hao Shang, who is dialing in live from China. Also Alexander Gyllenberg, who's a senior analyst in the Frontier Markets team, and David Nichols back on stage for this panel. Okay, so David, we'll kick off with you. It's been a volatile few months for the global financial markets. How would you characterize emerging and frontier markets, how they've fared year to date?
Yeah, no, I think volatile is an understatement, but it's I think Christine really explained it well, that markets move based on expectations, right? And so in order to understand market performance year to date, where basically frontier and emerging markets are up around 9%, S&P is just slightly negative to flat, you just got to look at what people were expecting at the start of the year and what actually happened, right? And actually at the start of the year, everyone was expecting some level of tariffs, right? And of course, the Liberation Day announcements were much worse than expected. But actually where we are now, more or less in line with expectation, really. So I don't think it's a huge surprise that markets are sort of relatively strong, I would guess, more than people might think, given the barrage of negative headlines. But of course, I think what has changed versus expectations is just quite the level of sort of chaos and uncertainty coming out of the US. And that's driven to obviously the treasury sell-offs, really major moves in global currencies compared to the dollar, which obviously gives a great tailwind for emerging and frontier markets. And I think that's really the sort of narrative that we would expect to continue with, of course, US still looks quite expensive at 20 times PE, with emerging markets trading around 12 times, despite better earnings growth, much better GDP growth. So I think that's probably the main story. But of course, the other huge driver that has changed compared to expectations at the start of the year was, as Anders said, this DeepSeek discovery in China. That, one of the narratives about China is it because they don't have chips, they can't compete, they're going to fall behind US on tech. But actually, that could not be further from the truth. It's not just DeepSeek, it's BYD cars. I mean, it's really, really everything. So I think that's probably the the main reason, if you want to understand why emerging markets have actually outperformed, it's the level of chaos in the US, but then also this sort of tech revelations coming out of China.
Thanks, David. And I touched upon the trade deal being announced this weekend between China and the US, which is obviously another, hopefully, boost to the markets. So with that, how, being on the ground in China, can you share with us your latest, what is the latest comments on the ground coming out of this trade deal and the reactions to it?
This past weekend, China and the US held the first set of high-level trade talks since the start of Trump 2.0. So the meeting were held over 2 days in Geneva from 10th to 11th, with China's Vice Premier He Lifeng meeting counterparts from the US, including US Treasury Secretary Scott Bessent. In terms of the outcome, both sides agreed to a 90-day pause with a significant rollback in tariffs. So China used to be taxed or supposed to be taxed 145%, and now it is lowered to 30%. And then from the US, the tariff that China would impose on the US is to be reduced from 125% to 10%. And then also both sides agreed to continue active discussions and prevent decoupling, with each side establishing key points of contact, and in this case from China, He Lifeng, and then from the US, Bessent as well. So that's what actually happened. To me, I would say the timing and then the tone was actually quite surprising. In terms of direction, of course, most people think this high tariff would be unsustainable because for the US, inflation is a key issue, and for China, growth is a key problem that they need to tackle. And to solve both, a lower tariff would be desirable from both ends. So direction-wise, it's not surprising to me at all. But in terms of timing and then the tone, as I said, are really beyond expectation. So timing-wise, a lot of people expect this to be a deal to be reached in the next 6 to 9 months. But actually, even though it's only a 90-day pause, and then the tariff may be delayed again, but then this timing is really faster or sooner than expected. And then tone as well. When I watched the press conference from the Chinese side, everyone were having a smile on their face, saying this final decision was reached with mutual respect from both sides. So I think that's a really positive, at least expression I can take from the Chinese side.
Thanks, Hao. Good to hear. And I know that you're out on the road pretty much every week, visiting, hundreds of companies per year. So it's only been a few days, but what's the general sort of reactions that you're hearing from the actual people on the ground and the companies, in our portfolio about the situation?
Yeah, sure. So I would say most people were surprised, as myself. So earlier, all the people were kind of expecting. I mean, in the first round, before the Liberation Day, everyone was kind of expecting a tariff increase from Trump because he has been complained about this for quite long, but the escalation quickly to above 100% was surprising to everyone. At that moment, business were actually quite difficult for the Chinese companies because most of the Chinese companies were only earning somewhere like 20% gross margin and then 10% net margin if they do exports to the US. So everyone was kind of shocked. But again, this weekend, the news quickly came out with the rolling back of around 100% tariff. Everyone was just happily surprised. But to be totally frank, I think everyone is still trying to digest what has happened. And very likely they are talking to their clients again in how much they need to do in the next I would say probably 2 months. Like there was a 90-day pause, but that's counting from April. So for another 2 months, I guess most people would be really busy in China trying to export as much as possible for the possible risk that may happen after this 90-day pause.
All right, thanks, Hao. And of course, we'll continue to monitor the developments very, very closely here over the coming 90 days then. So China, of course, the largest emerging market. Moving on to the second largest, then India, which has, of course, been a standout growth story of the past decade, I'd say, and continues to be so, really. But David, how sustainable would you say that the momentum is in India, and how do you view the stock market going forward?
Yeah, so India's been really the only major global market that has outperformed the S&P 500 over the last 10 years, and for good reason, of course. It's been growing very strongly throughout the cycle, really. And the story going forward is pretty simple, actually. You know, I think global investors are just increasingly looking beyond US in order to access structural growth. And where can you find that growth? Well, we heard from Anders that European growth might be 1% if we're lucky. You know, India's growing at 6 to 7%. So clearly there's an opportunity here, and we're really starting to see that in flows. So we had 26 billion of outflows from Indian equities by foreigners from October to February, and that's now starting to turn. We've seen 3 billion of inflows, and it's really accelerating. But in terms of opportunities, I mean, I think it's exactly that because of these outflows, the market's actually corrected fairly significantly. And so now we're seeing companies that used to be extremely expensive actually trading at relatively reasonable levels, right? And I would say it's even more true if you look beyond the index and really at individual companies. And as an example, we added this year a company we've been wanting to add for 3 years, but we've just found it far too expensive. It's an exceptionally high quality bottling company, growing at around 30% per year. But yeah, at its peak in 2024, it was trading at 80 times PE, which is, of course, extremely expensive for this sort of company, despite the quality. But actually, we picked it up earlier this year at around 40 times PE, which I think is actually a very good value. So it's these sort of opportunities, and that's, I think, why the global investor set are really warming to India right at this moment, is because of that sort of valuation argument. In terms of the risks, I think people obviously mentioned the Pakistan conflict, but it definitely feels like this is at least the intense military phase is very much finished. You know, Indian Premier League matches are returning from tomorrow, of course, which is very positive. And so actually, really, I think we see the risk in India mostly on the micro side, so the company side, right? And that's why it's really important to sort of do your homework and really find these companies that can deliver the excellent growth that any DCF model will show you. So yeah, that's, I think, what we're focused on.
Sounds good. Alex, welcoming you on to the stage then. Frontier markets, we've spoken mostly about emerging markets now, but as I mentioned in my introduction, frontier markets have also performed very well year to date, returning about 10%. Can you comment on, I know it's a very diverse set of countries, but as a whole, how exposed is frontier markets to tariffs, and how do you view them going forward?
Yeah, as you say, it is a very diverse set of countries that constitute this investment class, basically, frontier markets. And the nature of that, these are a group of countries that are spread across the globe. They have relatively low integration with the global economy and are much more driven by the domestic developments in each of these individual countries than the global trade flows. So in general, the sort of direct exposure to tariffs is quite low in our investment universe. And the sort of strong performance that you've seen now matching 9% in dollar terms for emerging markets, but I think with lower drawdowns during the year, is driven by a country like Morocco, which is up more than 30% now in dollar terms. Very little exposure to tariffs, but completely driven by domestic factors. They've got the World Cup coming in 2030. There are a lot of large infrastructure investments related to that, and they had a tax amnesty. A lot of domestic factors in Morocco driving this rally, helping to achieve this positive contribution to the index. But back to the question, there are countries in the frontier markets universe that are exposed to tariffs, but that list is of those with more major exposure. That list basically consists of Vietnam. And Vietnam, they are currently negotiating a deal with the US. We will see how that plays out. But even sort of in the absence of a deal, the government of Vietnam reiterated their 8% GDP growth target. We heard 1% would be good in the US, and 8% would be even outpacing India's very impressive growth. And that is clearly an ambitious target, a challenging one, but it's sort of, it does tell you about the ambition of the Vietnamese government, and they are doing considerable things domestically to sort of reach that target, to boost domestic consumption, the domestic growth drivers, not to be as dependent on the export-led growth that has been a real success story for Vietnam over the past decade or so. They are sort of both proactively managing it, but there's also a sort of a potential deal upside there. And there are also some relatively clear winners of this trade tariff situation, or the sort of consequences of it, with lower oil price, lower dollar, you have lower inflation. So countries like Kenya, Egypt, Philippines are sort of directly benefiting from those developments. And when it comes to low inflation, with China, as we heard Anders mentioning, redirecting exports to the rest of the world, a lot of that will, of course, end up in emerging and frontier markets. You have another disinflationary effect, which will allow central banks in frontier markets to continue the rate cutting cycle, which will boost consumers' disposable incomes. And that's sort of the growth in consumer, the growing middle class. That's a key investment theme for us, and something we're targeting when we look at investments.
Thank you, Alex, and good to see that investment thesis basically is holding true, even in this environment. So Hao, moving back to you, it's been a very strong year, not only for emerging markets, but particularly China. So tariffs isn't the only topic in town, but what are the other sort of themes and areas that investors are paying a lot of attention to at the moment?
Sure. So of course, the first one, and then the most obvious one, is AI. So earlier this year, DeepSeek really caused the so-called Sputnik moment of China, where people started to realize that China is actually not that far behind the US in terms of AI. And then one of the key player or story we like in this theme is Alibaba, or Amazon of China, if it's easier to understand. But actually, they have one of the most advanced AI model in China, comparable to DeepSeek and then some of the other models globally. Also, they are the largest public cloud service provider in not just China, but in Asia as well, especially with this trend of implementing more AI into everything. Basically, their cloud business is going to generate a lot of profit. For example, you like in China, you can see all different consumer electronics trying to incorporate AI. For example, like you have an alarm clock that can can have AI function at the cost of less than $20, and you have all other different things. So for this company, Alibaba is only valued at 12 times PE versus peer, which is Amazon, valued at 31 times PE. But in terms of performance year to date, Alibaba generated 56% a positive return, while Amazon was negative 5%. So that's a very clear case, which we like, and then a lot of other people like in China as well. A second one, I would say, is energy transition. And a very clear example of that is BYD. So this company actually and officially the largest EV maker globally that produce cheap but quality EVs. And then they don't have any exposure to the US. There's no tariff risk on their EVs. And surprisingly, probably not many people know that they are actually more profitable than Tesla. Last year in 2024, their ROE is actually 24% versus Tesla, which were 12% only. And then the growth is actually much faster as well. In Q1 this year, BYD's car sales were up 93%, while for Tesla it's down by 13%. But if you look at the valuation, BYD is only trading at 21 times PE this year, while Tesla is trading at 160 times this year. I'm not saying that BYD is better than Tesla, but definitely is something that would be interesting to own in terms of in our portfolio or in any portfolio we believe to that invest in China. And lastly, of course, we have a lot of high quality companies at really low valuation. For example, we had this China Best Study Education, which is an education company, very defensive, very domestic, so no risk from US tariff. And then to provide quality education is actually quite immune to a bad economy as well, because education is for the future of your kids. But for this company, valuation this year is only 12 times versus an EPS growth of 50% this year. And year to date, share price appreciated 45%. So to conclude, we really enjoyed the PE trends in China. That's not the best for China, but globally very competitive. And also we like companies which are really high quality, but again at very low valuation. So that's all from me.
Great, thank you so much, Hao. And to wrap up then, for Alex and for David, if you just had to highlight a couple or three key sort of traits in how you're managing your portfolios in this environment marked by such volatility and uncertainty.
Yeah, I can start. And I guess the number one thing, kind of as we discussed on the first panel, is just to not panic, right? I mean, we're dedicated emerging frontier markets investors. We've been doing it for decades. And so this was not new for us. Maybe if you're a US investor, I think that the level of panic is probably higher when you wake up and see a 10% drawdown or something. So we haven't been wildly active, right, in terms of trades. It just goes back to fundamental analysis. And as I said, questioning, as Christine said, sorry, what our assumptions were and how those assumptions have changed. We sold one company that had this sort of material amount of export exposure to US from China. But apart from that, our portfolio, our Chinese names have basically none, no export exposure. And yeah, instead it's really focused on the kind of themes that Hao was talking about. So actually we're pretty comfortable with our Chinese portfolio and generating alpha there. In terms of looking rest around the world, it's just about finding these opportunities. Like I said, with this Indian company, 3 years of following it, finally we're ready to pull the trigger just at the right time. So it's more about that rather than any sort of wholesale sweeping sort of panicky changes, I think.
Yeah, I think I can agree with what David said here. Keeping a cool head and trying to, we are investors, we are not traders. We look for the long term. And having said that, there are, of course, when there are large market movements, there are opportunities that arise when companies with little operational impact or even none trade down with a general negative sentiment and risk reward improves, then there are of course opportunities. But I would say we haven't been that active either. We have a portfolio for the long term. We've done some practically speaking, like taking down Vietnam exposure a bit by exiting one of the banks, which was at peak valuation levels, looking at historical where it's been trading. And we've increased in some of these, as I mentioned, countries and companies exposed to this low oil, low inflation beneficiaries of that. So in Egypt and the Philippines, we've been adding a few names It's now our portfolio is at 6.5 times P and 9% dividend yield. So I think that's it's still looking like a very interesting and attractive risk reward and investing proposition in frontier markets.
Great. So thanks to both. And as Per mentioned as well in the beginning, I mean, clearly we've had volatility, but that also creates a lot of opportunities. And I think especially in emerging frontier markets, the role of active management becomes even more important in times like these. So thanks to you guys and also Hao for joining in. That brings us to our next panel, also very timely, focused on Eastern Europe and situation there.
Yes, hello. So I'm Anja Waldscheid. I'm actually based in Berlin, where I speak to our clients in Germany and the DACH region. Eastern Europe has been attracting a lot of interest among our clients in Germany and elsewhere, as it's one of these very dynamic regions offering exciting opportunities and strong growth. At the same time, the region is evolving, and there are shifts. There are shifts in trade, investment, alliances, infrastructure, and these shifts are reshaping the region and how capital flows. And of course, there's the whole theme of rebuilding Ukraine, which is going to add another angle to our investments, probably in the future. So I'm very happy here to have Egle and Madis and to share some thoughts on these developments and also the specific risks and opportunities that investors are facing. So Egle, you are managing our public equity strategies for Eastern Europe, and you won this year the Lippe Award again, I must say. And Madis from Tallinn, you are heading our Baltic real estate investments with already 4 successful funds and 5th one coming up. So let's get right to it. Egle and Madis, what would a large-scale reconstruction of Ukraine mean for the broader Eastern European market in terms of investment flows?
Yeah, that's a very critical question. I don't think it's fully priced yet. And I think we need to look at it from even like a long-term historical perspective. Ukrainian reconstruction in the post-war Europe will be one of the biggest, most economically and geopolitically significant efforts. And in that respect, World Bank is estimating that around 500 billion euros will go into that reconstruction over 10 years of time. Just for a perspective, it's more than 50% of the entire Polish GDP. I'm not saying just to kind of give you example. I mean, of course, it will have spillover effects to the neighboring countries. And the countries like Poland, like Turkey, they are large enough, close proximity, they have the scale, they have the capacity, and they have the knowledge of the Ukraine market historically to actually be involved. Of course, there will be other countries like China, like Korea, like other large EU countries. But from our perspective, it doesn't need to be that much to have significant impact on companies' profitabilities. So that's why we've been in the last, since the beginning of the year, looking into companies, which ones can be involved in this great effort. And that would be, of course, construction companies in the region, infrastructure, cement producers, but also retailers, those companies that they know consumer. When Ukraine will be back to business, there will be a lot of economic activity, and that will be definitely benefiting companies that already had the presence before the war. So these are sort of more specific events that we were trying to position our funds, and we repositioned about 20% of our funds to these exposures. As a blanket sort of impact for the region, it will be higher GDP growth, it will be lower risk premium, it will be probably lower energy prices, meaning lower inflation. So all these positives will be not even company specific. So of course, and as I started it, I don't think that, you know, it gives the positive boost to the market, but it doesn't really reflect yet in the potential earnings of the companies which we expect in the future.
Yeah, of course, I think peace probably need to be achieved as well. That's one important part of that. So, but hopefully it will be. Give a chance on that, and I think the one is like a build-up process, which is kind of opportunities for construction companies, for industries, on that. So, but looking on the longer run, I think the Ukrainian is now facing towards the west, and that's integration of businesses is probably very, very big opportunity. Whereas I think the closest allies being in Ukraine, the Baltic states and Germany, of course, on that. So I think all this region has a very good opportunities on once the Ukrainian peace is achieved, and Ukraine will be started to integrating on the EU market, basically on that.
Mm-hmm. Eastern Europe has been one of the economic bright spots recently. How would you describe the current investment climate there in the region, particularly for listed equities?
Yeah, so the climate, I think most importantly, it's been fundamentally and structurally improving. So not only that we saw a very good stock market, which partially surged on very low valuations, which we saw a few years ago. So valuations was one thing, but I think these trends that we are speaking now about, the fact that money from the US is trying to find a maybe more stable home with growth and lower valuations. And people are talking about Europe, people are talking about emerging markets. Well, I think emerging Europe is the best of the both, right? It's both Europe and emerging markets. So it's not really surprising at all that with these shifts, Eastern Europe has been performing among the best. So Poland is up more than 30% year to date. In dollar terms, for US investor, it's up 44%. So that's huge compared, right, to what we saw in...
Just this year?
Just this year, just year to date. Yeah, and I mean, Poland is not a standout. If you see Greece, which has very good, sort of more stable financial and economic environment, also performed more than 20% up. So these type of performances, I think it's partially because of the Ukraine peace probabilities going up, because of the potential hopes for reconstruction, because of these flows. But also, we shouldn't forget that they are just a growth spot. GDP is growing more than 3% in Poland this year. Soon it will be the growth of China. You know, if we look at 26, 27, if you look at the sort of big houses forecasts, and Poland is not slowing down. It has a strong consumer, it has very strong investments, it has EU funds, 135 billion over the next 5 years. Just EU funds alone means 3% of GDP. So something is off, right? If GDP is growing 3% in EU funds, but we know that EU funds had some difficulty to come into the country, and there's a lot of ramp up still overdue. So maybe higher than 3% GDP growth of the next decade for Poland. Yeah, what else? And then we see the fact that valuations, I mean, you can't get around that, you know, Poland is still 33% below what European market is valued today. So at a higher growth. So for that, I think there will be still a bit of, you have also markets like Hungary, like Greece, significantly below their historical averages, 40% below the historical averages. So a lot of multiple expansion, but I'm really liking the EPS growth as well.
Yeah, and you're picking the right companies for that.
Yeah, I hope so.
Madis, real estate has historically been a major investment theme for Eastern Europe. So how do you see the real estate market also in light of now higher interest rates, geopolitical shifts? What is your take on
I think
that?
probably Eastern Europe being this kind of, I don't know, like a real estate game, it is probably now is like 3 decades old on the once the, let's say, all this old Soviet stock started to build a new modern offices where it doesn't exist, new retail centers which doesn't exist, all the logistics centers which doesn't exist. So that's where from it's all in Eastern Europe maybe started, but that's already 3 decades ago on that. So I think the real estate has been a pretty, let's say, having their kind of drawbacks in 2009, 2010, but after that has been a very long run in the very successful story on the real estate part. And as said, now all these turbulent times, it little bit has been maybe like forgotten on the way that actually interest rates has been going down on. I think we're waiting now that the base interest may be starting at 1 rather sooner than later on that. So, and that's looking on the real estate business, interest rate is the most important input on the way. That lower interest, meaning we're doing fine on that. And looking on our portfolio, we have seen that actually the resilience on all kinds of turbulent times what we have had, I think the Baltic states and Poland has been a recession technically on that, so number-wise. And now we are up and back, but our portfolio is very resilient. We have even chance to, on this high inflation environment, just to index more our incomes. And there is no debtors, there is no big vacancies on that. So I think the real estate sector has been really kind of strong performer on that. And looking on all this, whatever the turbulences we have had on this trade tariffs, on everything, so I think real estate is maybe, if someone is, investors are maybe sick on this kind of roller coaster on that. So, and the real estate maybe offering on that, looking on the kind of base interest rates which came down and giving good opportunities on that. And especially on the Eastern Europe, then also spoken on this nearshoring and kind of how this, let's say, protectionistic kind of things in US, how the being practice factories, everything on that. I think the mood also probably in the European market is also in a way to have this nearshoring to come into the Europe. We started on the COVID time already, where we had a disruption on the trade, on the physical interruption on that. So all of that actually leading that where actually the Eastern Europe is a natural location was a nearshoring on the production.
That
on
continued.
That. Yeah, and
after COVID.
Yeah, and looking on that, if the, let's say, Baltic states has been more famous on this IT sector, IT guys, let's say, don't need much real estate. On a COVID time, they just moved at home and continue to work on that. But let's say nearshoring on the factories and the logistics and all the system stuff, they need actually the real estate on that. So and that gives quite a lot of opportunities.
And what's your take on infrastructure? Because infrastructure development is also be a key theme for Eastern European competitiveness.
Yeah, I think the infrastructure we have seen this Rail Baltic as like a biggest project in the market, which is now has been started to develop very slowly, but still we hope on that. But I think the last developments is more related to the geopolitics, and as the defense spending is going up, if you, let's say, maybe in Western Europe, we're talking about, okay, now we are now at the 2% level. Then I think in the Baltics, the target is grow from the 3.5 to the 5%. And that's a lot of money actually on that. And it is not just an ammunition or tanks or anything kind of hardware on that. It actually continues also the infrastructure in a way, where to locate the troops, to build the roads, to build the training camps, everything around on that. And we have seen already now in the Baltics first PPP projects coming up, which giving directly the opportunity for the investors to be part of that, where government actually need to spend instead of 2%, 5%. That's a very big difference, and just to collect more money on the taxes, it is impossible so quickly in a way. So it gives opportunity to private investors to have some projects as well on the table.
Super interesting. So what are the main macro risks that you actually currently see for investors in Eastern Europe? And is there any, what what are the main factors that underpin the resilience of these markets? So
I have to echo, of course, the tariffs that I thought after this weekend I will not even speak about for Eastern Europe, but we still have to mention that there was, of course, the tariff risk for EU and hence tariff risk for Eastern Europe, but these risks are now lower. So the response of EU with the German stimulus is actually now much more positive for our Central European countries, since again it's a neighboring market, and any sort of activity increase in Germany means high activity in Central Europe, while it's just few bips impact potentially, if any, from the US tariff. So net now we face actually higher potentially GDP impact on them. So it's a positive risk became right out of this for Eastern Europe. Other risks such as I would say more country specific, and I would stick to Poland. And it's not unique to only Poland, but of course it has aging population. It has potentially labor shortage. With this type of growth, you need growing labor force. I hope that AI will help to solve some of that, but it's not only, and migration is one of those questions that not only Poland needs to solve, and it's a difficult one. Aging population comes also with increasing healthcare spending, increasing sort of pressure on that social contract. Poland pays a lot of welfare to the population, and is that possible to keep up that and do the energy transition and do the infrastructure projects and the 5% of GDP spending on defense. So these are sort of tough policy agenda that government is facing. I think will be probably better after the presidential election, still fingers crossed.
When is that?
We need the election, first round is this weekend, and then 1st of June we will have second round in Poland, and we expect that the presidential office will be more aligned with the government, the current sort of quite market-friendly ruling coalition. And with that, of course, it will be easier, but I think what nobody really talks, that the only way to tackle that agenda is to keep high GDP growth, because then you can get the budget revenue, you can sort of appease the sort of the pensioners and so on. So I think GDP growth will continue. What I'm also looking at is this kind of regionalization of the supply chains. It used to be nearshoring, now it's a regionalization. But Poland has been very good in attracting large business centers or sort of more sort of cheap labor based, but that's now still maybe going more into Romania. Turkey is good at that, and what we also see that. For example, from the BYD has been mentioned, they want to enter EU, and tariffs is one of the biggest issues. So what they are doing, they are building factories in Hungary, in Turkey, and this way sort of also boosting activity in our regions, right? So that's quite big trends that we are looking at.
How do you see that?
I think on the macro is the like increasing costs and the budget pending. Actually, what we have seen in the Baltics is the increasing taxes basically on that, and this overwhelming the businesses to grow as well on the way. But I hope that governments and everybody finds a balanced way that not to ruin the GDP growth on that, which is the most important to have on that. So, but let's say the overall outlook, at least the coming years, are seeming pretty well on that. So compared to last year on that.
Yeah, coming back. So how's the role of Eastern Europe evolving in a world of shifting alliances, nearshoring trends, and this greater regionalization of supply chains?
Yeah, so as I mentioned, I think it will have a bigger place in that. I think Eastern Europe has a lot to offer when it comes to skilled labor. Maybe it's not the cheapest place anymore, but I think in many respects, companies are finding quite good educated and skilled labor. And what's more important is, I think that once they start working for these offshore sort of projects, then afterwards we have this, for example, huge tech boom and startup boom in the Baltics after the business centers started and expanding their IT centers. So all the tech guys, after working for a few years on the big companies' R&D centers, they went on and they started their own startups. So the whole ecosystem is growing and very interesting. So there are lots of these interesting developments, I think, that are awaiting us, and together with this underlying growth, cheap valuations, and increasing investor interest in the region, I think it's a quite good place to be.
Do you have some final points on real estate on that?
Yeah, I think real estate is a important part, but I just wanted to add on that, the nearshoring on that, so that I think in the Baltics, the doing easy to do the business is a very important on that part, and that is actually enabling to do small companies. Maybe they look small in the European level, but to be a best one in a very narrow segment. And there are a lot of examples of these kind of companies where maybe their footprint is not very big on the market, but if there are quite many of them, they have a good footprint on all economy on the Baltics and Eastern European.
Thank you very much.
Thank you very much. We've now come to the end of this summit, and I don't know about you, but there's a lot of food for thought. And I would like to start by thanking everybody who's joined us, our speakers, all our customers, people here in Stockholm, as well as around the globe online. As I said, what we've seen today, what we heard today, is it's very complex, it's difficult, and it doesn't seem to get much easier. But that's in a world where we like that, because it does create opportunities. It may not be from day to day, but over time, that's when our role as stock pickers, bond pickers, real estate pickers, whatever picking it is, based on local knowledge, having ears and eyes to the ground, that's where we flourish. And I think that's pretty much explains also the transformation of East Capital Group. We have a very, very strong, and which we're very proud of, our roots in the emerging markets. That's transformed into frontier markets. We're now spanning across the globe, basically developed markets, both on equities as well as fixed income, and as Maris represents the real estate. And if you tie all that together, it's not easy, but you have a lot of cross-fertilization of information and skills. And I think that's been displayed very well today. We also, with Nico in the team, we have a sales team who are ready for you guys to leverage on that, be that on webinars or other things where we talk about themes or upcoming events. So please reach out to our salespeople if you want to talk to any of our portfolio manager or anybody else to get more information on that. And also, as I think is on the screen now, yes it is. In September, if you have time, we would love to invite you on our fall summit and see what, we don't know what's going to happen. For sure there are plenty of things to talk about on the 23rd of September. So on behalf of East Capital, I would like to thank you very much for joining us, and we'll see you soon. Thank you.